Welcome to Section 1 of the ASC 405 Liabilities Training Series. In this section, we are going to build the foundation, what a liability actually is under US GAAP, what three elements must be present, and how the four ASC 405 subtopics fit together. This is the starting point for everything else in the course. By the end of this section, you will be able to define a liability precisely using the US GAAP framework. You will identify the three elements that must all be present for something to qualify. You will explain why future plans and executory contracts fall outside the definition. You will apply that definition to practical examples you encounter on the job. And you will recognize what each of the four ASC 405 subtopics covers. Here is the question most people skip. What exactly makes something a liability? Under US GAAP, a liability is a present obligation of an entity to transfer assets or provide services to other entities in the future, as a result of past transactions or events. Every word in that definition matters. Present, it exists right now. Past transaction, something has already happened. Future transfer, settlement is still ahead. Miss any one of those three, and you do not have a liability. Think of these three elements as a checklist that must be completed in full. Element 1, there is a present obligation, meaning the duty exists today. Element 2, it arose from a past transaction or event, something that has already occurred. Element 3, it will require a future transfer of assets or services to settle. The surprising part is how many items people want to record as liabilities that fail at least one of these tests. We will look at those in a moment. Here is the key thing: each element acts as a filter. The present obligation test eliminates future intentions. If management plans to restructure next year but has not announced it publicly and has no legal obligation yet, there is no present duty. The past event test eliminates anticipatory entries. You cannot record a liability for a transaction that has not happened yet. And the future transfer test removes vague business risks. General market uncertainty does not become a liability until a specific obligation is triggered. Watch out for this one. It is where most recognition errors happen. The liability definition requires a past event that has already created a present obligation. That sentence is doing a lot of work. Before you record any liability, ask yourself, what is the specific past event that triggered this? If you cannot point to a concrete past transaction or occurrence, you do not have a liability yet. This single question will save you from premature entries and from missing real obligations. Let us put the definition to work. An invoice from a supplier for goods already delivered, liability, because the past event is the receipt of goods. Wages earned by employees who have already worked, liability, same logic. Management's plan to buy equipment next year, not a liability, because the past event has not occurred. A purchase order for undelivered goods, not a liability, because both parties have yet to perform. And a customer prepayment, yes, a liability, because you have received cash and now have an obligation to deliver. This is where things get interesting. A lawsuit filed against your company sits in a gray zone. The past event exists, the lawsuit has been filed, but whether a liability must be recorded depends on a SC 450. You need two things. It must be probable that a loss will occur, meaning more likely than not, and the amount must be reasonably estimable. If you can estimate the range but not a single number, you record the minimum of that range. Both conditions must be met. Probability alone is not enough. Most of what you see on a balance sheet falls into a handful of categories. Accounts payable covers amounts owed to suppliers and is always classified as current. Accrued liabilities, wages payable, accrued interest, accrued rent represent costs incurred where the invoice has not yet arrived. Deferred revenue, also called a contract liability, arises when a customer pays before you have delivered. And the current versus non-current split comes down to timing. Will the obligation be settled within the next 12 months or operating cycle? If yes, it is current. Most people assume a liability only exists if there is a signed contract or a legal requirement. That is mostly true under US GAAP, but there is a narrower category called a constructive obligation. This arises from an established pattern of practice or a public commitment. For example, a company that consistently refunds customers beyond its written warranty policy may have created a constructive obligation. The key difference from IFRS is that US GAAP applies this concept more cautiously. When constructive obligation is even a possibility, escalate to your team lead. ASC 405 is organized into 4 subtopics, and knowing what each one covers matters for looking up the right guidance. ASC 40510 is the overall subtopic. It provides the general recognition criteria, the definition of a liability, and classification guidance. ASC 40520 deals with extinguishment, the rules for when a liability is removed from the balance sheet. ASC 40530 covers a narrow category of insurance-related assessments, and ASC 40540 handles joint and several liability arrangements, where multiple parties can each be held responsible for the full amount. Joint and several liability deserves its own moment because it is counterintuitive. If you and a partner are jointly and severally liable for an obligation, the creditor can come to you alone for the entire amount, not just your share. Under ASC 40540, each party recognizes their own portion of the liability, and they assess whether any co-obligors are expected to default. If a co-obligor is unlikely to pay their share, you may need to record that additional exposure. This matters especially in joint ventures and co-signed financing arrangements. Let us bring it together. A liability under US GAAP requires 3 things simultaneously: a present obligation arising from a past event that will require a future transfer of assets or services. If you cannot identify the past event, you cannot record a liability. Future plans and executory contracts fall outside the definition entirely. Lawsuits and contingencies follow the separate ASC 450 framework. And the 4 subtopics of ASC 405 each address a distinct area, from general recognition to extinguishment to joint and several arrangements. Thank you for completing this section on liability definitions and foundations. Thank you for watching. Subscribe for more training from PNJ Group.